Have you ever been told that you should buy your rental property through a limited company? It's usually someone down the pub, isn't it, who says something vague about tax and then kind of walks off and leaves you none the wiser. Anyway, I'm going to help you clear that up today. I'm Justin from Ask JT. On the whole, I help small business owners improve their financial situation, demystify things in their business. But today, and more importantly, I want to talk to you about my life as a property investor. And I'm one of those as well. And I'm also the FD at a letting agency as well. So I know lots and lots about property, and I've been helping landlords through my accountancy practice for many years using limited companies for property. So I'm probably the person that you want to listen to on this subject because I know a lot. So let's get going with it. What is a buy-to-let company? And sometimes this is referred to as an SPV. You might have heard that phrase, which is really refers to as a special purpose vehicle. So in essence, what we're going to do is, rather than buying a property personally, a company is going to buy it. A company is a separate legal entity. You ultimately own the company because you own shares in the company. So therefore, indirectly, you're owning the house. It's a bit like, I suppose, holding the property at arm's length. That's the easiest way to describe it. There's more admin to use a company. That's absolutely the case. Sometimes it's a bit more expensive in terms of those admin costs, especially if we're taking finance and things like that. But in a lot of cases, it's completely worth it. So let me get into why it's actually worthwhile using company. Well, the first thing is that you get full relief for your mortgage interest. The government, quite a few years ago now, brought in something called Section 24, which limits the amount of interest that you can have against your own personal rental income. So if we bought a property personally, we've got a mortgage on it, the government basically said, to be honest, you can't have full tax relief at your effective tax rate. So if you were a 40% taxpayer, you're limited to 20%. It's actually a little bit more complicated than that because of the way they calculate rental profits, whereby, let's say, for example, that you had a rental property generating £10,000 a year and you had mortgage costs of £5,000 a year. The government would say, no, your rental profits are £10,000. We'll calculate your taxes and then we'll give you some relief towards the mortgage. The problem with doing it like that is it can actually push you into different thresholds. So you can all of a sudden find yourself in the 40% threshold, or you could be suddenly losing your personal allowance or losing your child benefit, and it does skew the profit situation. So actually a limited company, not only does it get a full deduction for interest relief on mortgage costs, but it can prevent some of those things like moving of thresholds from happening. Corporation tax is also lower than the higher rate of income tax. So a company, first £50,000 are going to pay tax at 19%. And obviously, if you're a 40% taxpayer, you're going to pay tax at 40%. There is a little bit of a thing to be aware of is you do really have to leave the profits in the company, and most landlords on this journey are looking to build up a property company in the long run, so they want to roll their profits in. So it works really nicely. You're not caught by the mortgage interest restriction. You're being exposed to a lower tax rate, and that means that you can actually push on a bit faster with your property business as well. It's perfect for growing a portfolio. The one word of warning I would say is if you need to take the money out of the company, you might find yourself in a situation where you're actually paying a higher tax rate. And that's really because if you're already a 40% taxpayer, dividend taxes are 33.75% and your company's paid tax at 19%. It's not really fair necessarily, that's what the government will tell you, to compare corporation tax rates and dividend tax rates. But for the purposes of this, I think actually it probably is, because if you want to extract the money, you're going to have to pay corporation tax and dividend taxes. So it can expose you to a tax rate above 50%. Very interestingly, though, because you're not being affected by this restriction of mortgage interest, if you are at the higher end of earnings, so for example, this was preventing you from going into over 100,000 where you'd lose your personal allowance, actually it can still be worthwhile. It can actually work out cheaper, which is quite interesting as well. The next part is that the shares are easier to pass on than bricks and mortar in a company as well. So in terms of succession planning, it can be easier to actually pass the properties through leaving the shares to a family member than anything like that. There are some really complex things around IHT planning and property companies, and you really need to go and take specialist advice on that. In terms of if you're quite young and you're just looking to build a portfolio, say you're a husband and wife, for example, and you've got a company owned 50-50 and you want to work on it for the next 10 years and you've got like a 20-30 year plan to kind of build this up, actually you're probably all right. You don't need to worry about IHT planning for now. I think it is something that you need on your radar, and then you need to pick it up a bit later as well. So hang on a minute, I've told you all these positive things about having a property through a limited company, but there's got to be drawbacks, surely, as well. You've got more admin with running a company. You've got company accounts, you've got the corporation tax return, you've got company's house filings like your confirmation statement to make and things like that. Mortgage rates are usually higher through a company. I think this is improving actually over the last few years as well. Lenders will ask for personal guarantees from the company, but you'll find that the arrangement fees tend to be a bit higher and the rates tend to be a bit higher. I think the mortgage lenders, they know why you're doing it, they know why you want to do it, and they're monopolising a little bit on that as well. If you do want the cash, I've already alluded to this, to take it out of the company, you might find yourself where you're paying quite a high rate of tax. I think really work this out, what your plans are. So if you need to take the money out straight away, then potentially actually a company may not be the right option, but try and run a few simulations and numbers, I suppose, just so you can understand what you're doing with it as well. If you think that you're going to buy a couple of rental properties and they're not going to put you over into the 40% tax threshold, you might be better owning them personally. In my view, I'm not a big fan of clients owning just one or two properties. I think it's quite high risk to do that. As soon as you've got a bad tenant, all of a sudden it's an absolute nightmare. And I'll give you a quick example. Is one of my clients' first rental property that they did. She's owning it personally. She moves these tenants in, they pass the reference checks, and then in month 2, the default on the rent, and they can't get access to the property. And then lo and behold, 3 months down the line, they find it's been turned into a cannabis farm. Huge amounts of damage. They'd lifted the floorboards, they'd imported soil to grow the plants. I mean, it was just an absolute disaster, and that was the first property. Now, if you've got 4, 5, 6 different properties, then you're protected. And at the moment, I have 3 problem properties in my portfolio. I don't have a massive portfolio or anything like that, but I've got 3 problem areas where the rent hasn't been paid on time. Actually, because I've got a bigger portfolio, I am protected from risk a little bit, so do bring a bit of that into your thinking as well. If you already own property personally, then just be super careful before you think, I'm just going to transfer that into a limited company. That can trigger, and most likely will trigger, stamp duty, land tax and capital gains tax. So if those properties have appreciated in value, when you sell them to a company, it's a separate legal entity and it's likely to trigger capital gains tax and also stamp duty, land tax. There are structures that people are selling out there to do with partnerships and things like that where you can kind of do that. You need to go and speak to tax avoidance specialists. My view is actually, yes, you can put that to one side. This is all really about today. It's about building a new portfolio. Anyway, it's not that simple, but to be honest, if you work with really good people and professionals, like people like me running accountancy firms who know what they're doing, they can actually sort of take all of this pain away with running a company as well. So just in summary, who should use a limited company? I think if you're high rate taxpayer and you want to get into property, absolutely. Number 2, you don't need the rent yet. Number 3, you're looking to reinvest the profits in it. And number 4, that you're looking to the long term. It could be family legacy, joint ownership, succession planning, all that sort of thing. If your income is around 60,000 to 80,000 and you've got children, that's a real danger spot for you. And if you're 100,000 to about 125,000 pounds worth of income, then these are danger thresholds. There are effective tax rates of 60%. When you factor in the actual relief from mortgage costs as well, you can actually find that, believe it or not, you can actually pay more in tax than you've earned. I know that seems absolutely crazy if you were holding them personally. I've got a fact sheet which I'll put in the description of this video that you can go off and find and click and download if you so wish. And I've got some worked examples of the different scenarios, so you can actually see that scenario of where someone actually pays more tax than they've actually earned from the property. I know it's a crazy system, but this is why people do it as well. And that's why I think you shouldn't just blindly go into property and say, we could never have a situation where we'll pay more tax than we could possibly earn. Well, it can happen. And that scenario I saw with a client who invested in some property, that tapped on my door at work at my accountancy firm and said, Justin, can I have a consultation with you, because this can't be right. And what was actually happening is they were having to repay their tax-free childcare, and they were losing their personal allowance, and they were being restricted on mortgage costs. And it's that kind of perfect storm of things that happen, and we were able just to restructure things for them to make sure that they were back below that and reclaim their tax-free childcare as well. So, but just in summary, when to stick to personal ownership is, if you are a basic taxpayer and you only want one or two properties. But I have mentioned that the dangers of doing that. Just to get back into the kind of the tax rates very, very quickly, is let me show you just a couple of little examples. And I know it's difficult to visualize on a YouTube, which is why I suggest you go and have a look at the download as well. So what happens when you are in a situation where, let's say, you're earning £55,000 from a PAYE job, and you've made £10,000 profit from a rental property? Well, all of a sudden you come and have a consultation with someone like myself, and I look at this, how you've calculated your profit, and I go, oh, hang on a minute. No, you've got £8,000 of mortgage interest in there. So your profits are £18,000 in HMRC's eyes, and then we'll calculate this tax relief later. And you're going, well, hang on a minute, what's going on here? All of a sudden, that's going to raise the total amount of your threshold earnings. So where you were just thinking, well, hang on a minute, I've got 10 grand, I'm likely to be about £65,000. I'm going to lose maybe a quarter of my child benefit. Actually, if we put another £8,000 onto that, all of a sudden you're in a situation where, hang on a minute, I'm more or less going to be losing all of my child benefit. You can all of a sudden, although you've got a £10,000 profit in my little example that I'm giving you here, is that you have a tax bill of £5,600. And that seems like that's a lot of money, isn't it? But imagine that you cross the £100,000 threshold and you lose your tax-free childcare on that 10 grand profit. And I kid you not, I've done the figures, you can check in my worksheet on this, you could have a tax bill of £13,200. So you actually, you're going to pay £3,200 more to HMRC than you even earned off the property. And so the way they're doing the calculation, it is quite a complicated calculation as well. But with the company route, just as a comparison, what's going to happen is, well, actually, your income stays in the company. You've got, let's say, for example, you've got 20 grand of rental income, 8 grand of mortgage costs, and 2 grand of repair costs. Taxable profit of 10 grand in that example. Corporation tax is £1,900. Now just compare that to the other example of £5,600 I was just talking at before when you own it personally. It's a huge difference. If you actually took that money, that was the profit that was left in the company, out, you would get £2,565 in tax to pay personally on top of the corporation tax. So that would be about £4,465. The government are taking, in that particular example, of that 10 grand profit, about 44.65%, and potentially there might not be any child benefit clawback or much reduced child benefit clawback. So you could be in a better place basically than actually if you owned it personally. But that's where professionals who know what they're doing can really guide you and help you with this as well. Yeah, I mentioned as well about transferring existing properties in. It's just be, again, super careful about doing anything like that. It is rarely tax free. I think you might be looking at these situations, go, well, hang on a minute. Justin's talking about saving all this tax. Surely it's going to be better just to pay those upfront taxes, put the properties in the company, and then I'm going to be paying less long-term tax as well. You've got to do a very, very careful calculation and work out what the capital gains tax is going to be and what the stamp duty land tax. The last budget put that stamp duty land tax rate up. So, it starts at 5% now. We were talking about 3%. So what you've got to do is look at the total repayment period. So how much profit are we generating on average per this particular property? What would the total cost of taxes be to move them into the company? And how many years will it take me to repay that upfront tax to move them into the company as well? So, final thoughts here on this one. Should you use a limited company for buy-to-lets? Yeah, I think it's a good move, basically. I think it's overkill if you've only got 1 or 2 properties, little flats, for example, that aren't really generating that much income, or they're going to stay at a fairly low level and keep you below 20%. But on the other hand, I think sometimes situations can change in the long run. So you might be a 20% taxpayer now, for example, but as your career develops, all of a sudden your income starts increasing, and all of a sudden you're like, oh God, I wish I put those into a limited company. So you do have to think really kind of in the long run as well. Look, if you're looking for a bit of help on this front, if you search for orangeumbrella.co.uk, you can find an appointment booking service and you can book in with me if you wanted to, and I could explain the whys and what fors of property SPVs and look at your particular situation. If you've liked this video and you found it helpful, please press like and subscribe to my channel. It makes a huge amount of difference. If you're looking for other kind of information, if you're maybe a small business owner or a landlord, there are things on my blog at askjt.co.uk/blog. And I also have a podcast which you can find on Spotify and Apple. Just search for Ask JT and you'll find my podcast. Anyway, I'll see you in the next video. Bye.